This is an Uncovered Japan Company research report on Hamakyorex Company Limited, ticker 9037. Hamakyorex runs warehouses and delivery fleets for everyday goods, yet earns roughly twice the operating margin of its logistics peers. The difference is a management culture built around closing each site's profit and loss every day. The investment question is whether that quality can keep compounding after the market has already re-rated the shares. The report is dated July 6, 2026. At that point, Hamakyorex traded on 12.8 times forward earnings and 1.41 times book, with a 2.47% dividend yield. Its group operating margin was 9.5%, return on equity was 11.4%, and the equity ratio was 56.8%. 20 consecutive dividend increases reinforce the quality case, but the valuation is now around the logistics peer range rather than deep value. A third-party logistics contract means Hamakyorex takes over a client's distribution operation. It receives goods, manages inventory, handles labeling and other value-added work, and delivers to stores. The company operated 194 centers, with utilization above 95%, and has signed roughly 15 new clients a year. Because a center takes about a year to ramp, contract wins create a visible pipeline before revenue appears. Hamakyorex calls its core technique the daily-P&L. Every center and depot closes its economics at the end of each day, so a productivity problem is identified that evening and corrected the next morning. The numbers are visible on the floor, giving part-time and full-time staff shared cost ownership. Hamakyorex can then open those economics to clients and propose shared savings. Competitors can buy similar software, but reproducing a culture trained over 3 decades is much harder. The segment split reveals the economics. Logistics centers produced about 65% of sales, but 88.5% of operating profit, and a 12.9% margin. Freight transport earned only 3.1%. That low-return arm is the group's clearest self-help opportunity. Pricing is recovering, and management plans to convert selected freight terminals into logistics center space, moving assets from the weak segment toward the high-margin core. The handling mix is deliberately defensive. Home care goods were 31% of logistics center sales, food 27%, medical and healthcare 22%, and apparel 18%. Roughly 80% is consumer staples, and no category is larger than a third. Medical logistics is especially attractive because temperature control and distribution compliance support higher value work. The mix reduces dependence on one shipper or one cyclical end market. From fiscal 2022 to fiscal 2026, revenue rose from 125.1 billion yen to 155.5 billion, a 5.6% compound rate. Operating profit grew faster at 7.4%, reaching 14.8 billion yen. The group margin climbed to 9.5% even as personnel costs increased. That widening spread is the financial evidence that the daily P&L system is more than a slogan. Cash conversion is another strength. Operating cash flow reached a record 20 billion yen in fiscal 2026, while free cash flow recovered to 9.4 billion after a heavy center building cycle. The business carries little inventory because it moves other companies' goods. Despite owning substantial land and buildings, cash of 26.5 billion yen roughly matched borrowings of 24.8 billion. The group can invest, repay debt, and raise dividends without depending on outside capital. Japan's driver hour restrictions and chronic labor scarcity make in-house logistics more difficult, encouraging shippers to outsource. E-commerce and medical logistics add further demand. Automation should favor a well-capitalized operator with strong shop floor discipline. And Hamakyorex is investing heavily in robotics, warehouse systems, and labor saving. But automation is double-edged. If turnkey systems become cheap enough, some clients could bring warehousing back in-house. The durable defense must remain operational culture, not hardware alone. For years, Hamakyorex traded around 7 to 9 times forward earnings. By the report date, the multiple had risen to 12.8 times and price to book to 1.41. The re-rating followed a clearer payout policy, a stock split, and broader recognition of the logistics outsourcing tailwind. The quality premium is understandable, but the easy valuation uplift is behind it. From here, returns depend more on earnings growth, the freight turnaround, and stronger capital allocation. These are the report author's scenarios, not recommendations or price targets. The bear case falls about 29% as the multiple returns toward 9 times, even without a severe operating collapse. The base case is roughly flat on price, with dividends lifting the estimated 3-year total return. The bull case requires a 10% margin and a further quality re-rating. This makes multiple mean reversion the largest risk, while the May 2027 midterm plan is the clearest potential catalyst. To conclude, Hamakyorex combines an unusual daily management culture, industry-leading margins, a near net cash balance sheet, and 20 years of dividend growth. The operating case is strong. The entry point case is less obvious after a substantial re-rating. The decisive indicators are freight segment margins, the pace of new center wins, labor cost absorption, cash conversion, and the next midterm plan's return policy. For the full evidence, assumptions, and sources, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.